What if I told you that dividend investors could be throwing away tens of thousands in potential gains in their investing accounts, and that this whole idea of making passive income from dividends is a bit of a myth? But let me explain, there's a bit more to it than that. So look, there seems to be a lot more talk now on YouTube, Twitter, and all your favourite social media platforms about dividend investing. All you need to do is invest in high-paying dividend stocks or even a single ETF, and you get paid this lovely free money every few months. You can take this free money, spend it on yourself, or you can reinvest it all and buy more of the same shares that have just paid you those dividends. The idea is simple, and you rinse and repeat this for many, many years, and you end up with a big enough portfolio that can pay you lots of money for your retirement, or hopefully even a few years earlier. The problem is, some of the people pushing this way of investing seem to be missing out on some of the biggest issues which you really need to understand before it's too late. Let me take you through a couple of examples first, as this is definitely an easier way to explain things. Now let's say that you've focused all of your income to dividend investing, and to make your life even easier, you've chosen to invest in an ETF which has hundreds of dividend paying stocks inside of it. In fact, you've chosen a super popular one that all of your friends told you was the best one to invest in. I'm going to run a couple of examples here, one from the UK, but also one from the US as well, which is super popular. But first, let's start with the UK. Vanguard's FTSE All-World High Dividend Yield ETF, also well known with the ticker symbol VHYL. Now, I know this one's really popular with a lot of you as it gets mentioned loads in the comments. And looking at it initially, everything looks great. Almost 1,800 companies inside of it, a relatively low expense ratio, billions of cash invested, and also the most important thing, a dividend yield of almost 4%. So if you manage to stick £10,000 in, you're going to end up with around £400 a year, split up across 4 different payments of £100 each. Now, you aren't stupid. You also think to yourself, let me look at long-term performance as well, because you want to make sure that the value of the fund is also going up, as 4% on its own isn't going to be enough. And you also see that it's doubled in value from its inception in 2013, where £10,000 or $10,000 would have turned into $17,000. Right, we're on to a winner then, time to go all in. I mean, who doesn't like dividends? You'd have to be crazy to turn away free money. But here's the problem. What if by investing into a fund like this, you could actually be costing yourself a lot of money in returns, and you could be better off doing something a lot simpler? Okay, check this out. If you compare the VHYL fund that we've just looked at to something like an S&P 500 index fund over as long as a time period as you can, things start to get quite interesting. What you're looking at on screen is 4 different lines, 2 for VHYL and 2 for the S&P 500. The huge important difference is that 1 line for each is for the total return, and this shows us what happens to your investment if you take all of your dividends and just reinvested them right back into the fund, which is a great strategy that many people like to use to grow their portfolio. The 2 best performing lines, the grey one and the black one, are both the S&P 500 index fund, which has delivered 167% or 197% with reinvestments since 2013. The lines below show VHYL, which shows either a 41% gain leaving out the dividends, or 83% if the dividends were all reinvested. Now, whatever way you look at that, missing out on 100% worth of gain is a huge difference, when you might consider that a boring old S&P 500 index fund is something that almost everyone tells you to invest in and forget about. Oh, and just so we don't leave out our friends over in the US, there's another investment that gets brought up all the time here on YouTube and everywhere else. It's Schwab's US Dividend Equity ETF, which goes by the ticker symbol SCHD. Shall we see how this one's performed as well, exactly the same way as we just did with VHYL? Well, here it is. This time the gap isn't quite as big, but the results end up in the same way. Now, since inception, you'd have been better off if you just stuck with an S&P 500 index fund when compared to this fund, both with investing the dividends or keeping them for yourself. I don't know about you, but I doubt that a lot of investors realise this or even consider that they might have just been better off by just doing this, because let's not forget that even a boring index fund does pay dividends too, just a bit less. So an open and shut case then, and everyone should stop investing in dividend stocks? Well, maybe, but as with anything in investing, there's always a few caveats and a few details that we need to consider, because at the end of the day, none of us know the future. And I think this is a good place to start. You see, if you do invest like this and have all of your money in a dividend ETF or a popular dividend stock, what you're saying is that you're making a bet that these stocks will perform better than something else. You're making an active choice and an active bet. Now, assuming that you want to make that most money, but then I appreciate that not everyone invests purely for the best returns, but let's put that aside for the moment. So when you make any investment, you're making a bet that where you put your money has the best chance to grow in the future for whatever timescales you have. The problem is, as I just said, nobody knows the future. Let me take 2022 as a really good example of what can happen in short time periods, as I think this is partly the reason that some of these dividend ETFs have gained a lot of popularity. But just before we do that, if you do like these kind of videos, please do me a huge favor, gently touch the like button below, and why not subscribe too? It's free and it always pays dividends, just in the form of new videos. Anyway, as you might remember, 2022 was a crappy year for investors in pretty much every kind of investment, whether that was stocks or bonds or something else. But saying that, some sectors did do better than others, even if the whole stock market dropped almost 20%, which was the worst decline since the global financial crash. For example, if we just go back to something like SCHD and choose a time period across 2022, we can see that pretty much the whole of 2022, a fund like this beat out the S&P 500. If we look here, at the end of 2022, where the gap is the largest, we can see that SCHD investors were only down around 4%, whereas those invested in the S&P 500 were down more than 16%, which is a massive 12% difference. So why was this? Well, you'd need to look inside the fund to see what's going on. Let's break it open and see what's inside. Right then, lots of big companies, no surprises really, lots of household names, and many that have paid dividends for a really long time. And also, you'll see that the fund is quite well diversified too across different sectors, which, when you compare this to something like the S&P 500 or even the Nasdaq, looks very, very different. You could argue that during 2022, lots of big tech companies or even fast-growing companies all got brought down back to earth because 2021 was such a boom year. And then once people sold out of those riskier stocks, they thought, well, what about investing back into these old reliable stocks which people are going to have to buy their products from no matter what the economy is like? I mean, certainly companies like Coca-Cola come to mind that seem to do very well no matter what interest rates are or how far we might be into some kind of recession. It was a similar story with stocks in the oil industry, record profits last year and lots of big gains and dividends for shareholders. I do think that because of this recent performance, a lot of investors have looked at these ETFs and thought to themselves, well, look how well they've done all while paying out a dividend, I better have a piece of that action. However, as I mentioned earlier, we don't know the future, and the bet that you're taking is saying that dividend-paying stocks will be another kind of investment, like a boring old index fund. Now, sure, over the next 10 or 20 years, it's perfectly possible that SCHD or VHYL beat an index fund, as we just don't know what will happen in the future. However, let me just throw in a couple of other things that we do know that you might want to consider before you go all in on dividends. Firstly, remember that dividends create a taxable event, which is just a fancy way of saying every time you get paid a dividend, you may have to pay taxes depending on your circumstances. So for example, here in the UK, if you invest in a general investing account, right now you're allowed to make £1,000 per tax year before you have to worry about paying any taxes. Now, outside of that, you'll have to pay tax depending on how much you earn, which can vary from 8.75% all the way to 39.35% if you're a high earner. Also, this tax-free amount, which used to be £2,000, is set to reduce down to £500 at the start of next tax year. So you can pretty much wipe goodbye to that allowance completely in the near future. And yes, if you're able to use in stocks and shares ISA, you don't have to pay any kind of tax on dividend income or capital gains at all. So that's a huge benefit. So just give that a think before you start to invest and make sure that you use the right account. Now, over in the US or around the rest of Europe, your allowances might vary and not everyone is as generous in terms of tax protection. I'm not going to pretend that I'm some kind of international tax expert, but over in the US, it looks like they have to pay tax on dividends from at least 15%, but this increases as they earn more, and they can only get some breaks if they invest inside their Roth IRAs, which are a good equivalent to our stocks and shares ISAs, but then the annual limit is just $6,000 compared to our £20,000 or $25,000 if you want to make an equivalent. Secondly, and this one only applies to people outside the US, if you hold stocks that are listed in the US and then they pay you a dividend, you'll be subject to what's called dividend withholding tax. It's not something that you have to focus on, and it's not something that you have to pay because it's automatically taken off by the time it even hits your account. But right now at least, it's charged at 15% of what you receive, which might not sound like much, but over the years this definitely adds up. And it might be a lot better if you just chose to invest in a company that didn't pay dividends in this case. Definitely some food for thought that not everyone's aware of, but also even an index fund investor feels the same pain if they receive a small dividend. It does get taxed either way. So look, this taxable event that's created isn't because you wanted it to happen. With dividends, it gets forced on you whether or not you like it. And depending on where you are on your investing journey, you might not actually want to worry about taxes on your dividends, and instead you'd rather be focused on trying to save more money to invest in the first place. Now, just before I get called an investing Scrooge or someone who's against dividend investing, there are lots of positives to this. Now, dividends are a really important part of your total returns, whether you see them or not. And in fact, if you took them out of the stock market entirely, the returns really wouldn't be that exciting. And also, a key thing that many people who are into dividend investing love about them is the motivating factor, and this can be really important. It can be really satisfying to see dividends go into your account and get bigger and bigger every quarter and every year as you invest more and more of your money. And it's almost a way to gamify investing as a challenge to see how big you can grow that dividend income as a way to eventually end up being something that helps pay with your bills and maybe even give up work. Now, I totally get this, and at the end of the day, if this helps you invest and is what you need to keep you going, then this is the beauty of investing and all of the power to you. As other people might give up way too early, because sometimes investing can be quite an abstract idea, and all you see is this number on a screen that you might not really feel like actual money. But just as a counter to all of this, and something that might have been explained a little bit earlier in the video, dividends are not free money. They might seem like a really great passive form of income, and to be honest, yes, you don't really have to do anything to get them, but it's your capital being returned to you. It's easiest as always in an example. So let's say Coca-Cola is worth £100 billion and they pay out one dividend a year worth 5% of their company. And just for fun, we'll say that you have £100 million worth of shares in the business. So using some quick maths, you'll be expected to receive £5 million as a dividend. Thank you very much. Now, on the day that the dividend leaves Coca-Cola and comes to you, they've just spent 5% of their entire company value on dividends. So rather than be worth £100 billion, they're now worth £95 billion. That £5 billion is no longer theirs, they've given it out to shareholders, so this reduces the value of their business. So sorry guys, there's no magic money tree, and you can't just take a dividend and then sell your stock the next day expecting to make some free money. Now sure, you can reinvest that money you've received and also hope that Coca-Cola keeps doing really well as a business and increases their share price as well as paying the dividend, but either way, the money has to come from somewhere. I know this probably isn't news to a lot of regular viewers, but I do still see this time and time again on YouTube and the rest of social media. The idea that somehow that dividend investing is just free money and that dividends are completely passive and you can end up living some kind of beach nomad life with yachts and Lambos. The reality, as I hope you've just seen, is that it's not free money. It will still take a really long time to make any kind of meaningful income. It's definitely not kind of get rich quick scheme, and it might end up giving you a headache because you have to deal with a tax man when you didn't realize that you had to. The bottom line then is just to be aware of what you're doing. As I said earlier, we truly do not know what type of investor is going to do best over the next 10, 20, or even many more years. It may well be that dividend paying stocks beat the whole market, but rather than take that bet, my personal opinion remains to keep investing regularly into low cost index funds and let the weights of the market take care of themselves. So rather than letting someone else do it for me and pick an actively managed dividend ETF, I'd rather just let the market take care of itself and focus more and more of my efforts and time getting more money in than trying to build up any kind of dividend income. But hey, never say never, and I can always use dividends when I get older if I really want to. Now, if you're still a bit unsure about dividends and want to know a few other key points worth looking into, I did do a video a few months back about 5 things that you need to know before you buy dividend stocks. Anyway, check that one out next. Thank you as always for watching, and as always, happy investing.